Okay, so welcome everyone to today's lecture in financial risk management. Last week we stopped with the basic definition of an interest rate swap. As you can imagine, a swap is, as the name suggests, the swap is a very simple contract actually. A swap is just that, a swap of usually a fixed versus a variable payment of any type and any kind. It can be an interest rate, but you can also construct a foreign exchange, a currency swap, or any payment, variable against fixed payment, that can be included in a swap. A swap contract is most of the time an OTC traded contract, an OTC product, meaning that you are not trading it on an exchange, but you're looking for an institutional, for a professional counterparty with which you enter such a swap contract. And it is just like that. It is a contract in which both parties agree on changing, on swapping fixed for and against variable payments. In the case of a simple interest rate swap, this is the exchange of, in general, fixed and variable interest payments on a nominal value. That's the principal amount. And you have two counterparties. If the counterparty defaults, quite trivially, you'll have counterparty risk, meaning that if your counterparty defaults, there is no one left to fulfill his or her side of the contract. So you will be standing without a swap contract. Thus, this is a swap, interest rate swap, and one important thing is that the underlying legal contracts, the transactions that initially define the variable and fixed payments are not exchanged, they are not swapped. Meaning that, for example, I could be a bank, I've given out a loan and I'm receiving a fixed interest payment from my customers. And I want to change this variable interest payment, this long position in the interest rate. I want to exchange this for a variable interest rate for whatever reason. And I'm looking for a contract party, a counterparty, and I will enter a swap contract. But the counterparty in the swap contract doesn't have to do anything with my underlying loans I've given out. It's completely independent of the swap contract. So this is an interest rate swap, and the payment balance is usually settled on the settlement dates. And last week I already told you that with swap contracts, usually if you want to price them, it's quite simple. You have a floating rate leg and a fixed rate leg. You can see and you can view both sides of the swap contract as a floating rate note and or a coupon bond. Then you can just price the coupon bond and the floating rate note, and the difference between the two legs will be the price of the swap contract for the one side or the other, depending on who's benefiting more from the swap contract at this moment. I gave you this example that if I want to swap interest rates now and I want to receive 10% fixed interest rate, and I will pay a variable interest rate, then the price of the swap contract will be very high for me because I'm demanding 10% fixed for a very low variable payment right now, a low interest rate. There are some different forms of interest rate swaps. For example, a fixed floating interest rate swap. Fixed rate payments are exchanged for variable interest rate payments. A basis rate interest rate swap or a basis interest rate swap is variable for variable. Does that make sense? Only if you take different types of interest rate levels and interest rate indices. For example, if you were to exchange the current interest rate from the United States for an interest rate in the European Union, then it will make sense. You have two different indexes and these will be exchanged. Or you could also exchange, well, it doesn't make sense for currencies. But here, this is a basis rate swap. Some other forms: amortizing swap, forward swap, extendable swap, callable swap, puttable swap. I think most interesting is the case of a swaption. That is simply the option, the right, but not the obligation to enter a swap contract. So you can start a swap contract later, but you don't have to. You have the option to enter a swap contract. And that's actually a pretty clever instrument, swaption. I will give you one example that is not on the slides. I mean, on the next couple of slides, you can read through all the details of an interest rate swap, and an interest rate swap is actually quite simple. Interest rate swap means you get 5% for, say, the Euribor or the Libor for any variable interest rate. You can agree on these swap contracts on any type of underlying. Do you know where swap contracts are quite common and frequently used? On which underlying? First of all, currencies, swap contract. It's a very simple instrument to hedge the currency risk. Euros for dollars, dollars for euros. And another big area in which swap contracts are used is energy markets. With energy markets, you can swap variable indices against fixed payments. And to give you a very simple example, now energy markets are quite complex. One of the more simpler markets in the energy sector is the market for gas. Gas is a little bit more, it's simpler than, for example, electricity, because electricity has, the electricity market is complicated and worsened by regulation. In German, I would only need to say EEG-Umlage, and you would immediately know that the price for electricity is heavily influenced by regulation. With gas, it's different. The gas price, usually, the gas market used to work like this. You buy gas from Russia, from Gazprom, for a fixed price. And you sell it to retail customers and to wholesale customers. And wholesale customers could even be the bakery. Bakeries are actually large customers at energy companies and gas companies, because they need gas to run their high temperature, large ovens. So you buy gas from Gazprom, from Russia, at a fixed price. And you sell the gas to your customers, wholesale and retail, also Groß- und Kleinhandels, Retailkunden und Großhandelskunden. You sell gas via an oil price formula. You might have heard that the gas prices are connected to oil prices for some reason. Historically, the idea was that if you dig for oil, you will also find gas. So the more oil you produce, you will also produce some natural gas. Okay. So historically, the prices for gas were connected to oil indices, like Brent oil. And what then happens is you sell your gas via an oil price formula, Ölpreisformel, same word in German, like $1 or €1 plus 2.3 times Brent oil index. And if Brent oil increases in price, you will get more, you will have higher revenues. If Brent oil decreases, you will have lower revenues because you are selling gas at a lower price. And your price will depend, the price you will be selling your gas at will depend on the oil price. That's one of the reasons why electricity companies tell you, we're sorry, we have to increase your gas bill. Why? Oil prices have increased. One explanation for that, one reason they give. And this is tricky for gas companies and for electricity companies because they have a fixed price for buying gas and they have a variable price for selling it. So as soon as the Brent oil price or any other index is at a significantly higher level, you do what? You do a swap contract. You will swap Brent oil. You have a long position in the Brent oil index. You will swap it in a swap contract for a fixed payment. And then suddenly you have a fixed price for buying gas, and you have been able to use a swap contract to fix your price for your revenues. And the difference will be your margin. Very simple, very common, frequently done by companies like RWE, E.ON, in their gas trading. It's sometimes not as simple as that, because still the indexes will fluctuate, but these swap contracts will be done with specialized trading companies. And because of the EEX here in Leipzig, we have several of these trading companies located in Leipzig. They specialize in offering swap contracts and other derivatives and to trade in electricity, gas, and in these indexes, because they know large energy companies are in need of these derivatives and these contracts, and they will try to make a profit from offering these contracts and netting their positions so that they also make a profit. And the large gas companies are able to fix their revenues and to fix their margin. So you don't need too complicated derivatives. A swap contract is sometimes your best option, but you can also use other derivatives. And what you do is you simply say 1 barrel of Brent oil, and that's a variable payment, the variable price, and you will fix it. I think Brent oil currently stands at $66. Maybe you will fix it at 60, and you're done. You know for the rest of the year what revenues you have. On a related note, you can see that this is not as easy as I've just described it to you, due to the fact that almost all large German energy companies have restructured their gas departments and their gas trading subsidiaries. It's still quite tricky. Okay. Fixed floating interest rate swap. I think the basic construction should be clear. One can now distinguish 2 types, a liability swap or an asset swap or an asset liability swap. Let's just see what this looks like. This is just the general structure. You have the fixed rate payer that pays a fixed payment to floating rate payer B, who pays a variable interest payment to A. You have some underlying loans or investments, but these do not matter for the swap contract. And in this case, this is the general structure. You might even have an intermediary, a bank in between, but this here above here, this is the swap contract. Okay. So let's look at a liability swap. A liability swap is both parties, A and B, are debtors. They have a debt with the 2 creditors, the Gläubigern, who have given capital to A and B, but A has to pay a variable interest rate payment, whereas B has to pay a fixed interest rate on its capital, on its loan. So both have taken up a loan, and both have realized that they would rather like a variable or a fixed interest payment. So they swap it. That's a liability swap. Could even be the case that they want this, they want to do this, and they take up the loans just for the, just to get the payments. Could also be. Asset swap, different situation. Both are now creditors. They've given out loans, for example. A and B get variable and fixed payments. Again, they swap them via the swap contract. And you get the asset swap. And as the liability is now clear, one side, one counterparty is a creditor, the other is a debtor, and they swap again the interest payments. Okay. Valuation. We've seen this before, very simple, coupon bond, floating rate note. You have the fixed rate payer who has a money market investment, which is usually the floating rate note, and they have a fixed interest product, fixed income product, and by combining these two with a long and a short position, you have 100 in capital plus 100 in capital minus, so that nets out at 0. And one side gets a variable payment and pays fixed, and it's the other way around for the floating rate payment. So valuation is actually quite simple. And I also told you that market conventions are that you don't pay a premium when you enter a swap contract. You can always adjust the the fixed rate in a swap contract, may be a fixed rate interest payment or a fixed currency rate. So why use a lot of capital and force one side of the contract to pay up a large amount of money right now if both parties are actually just interested in the price evolution and the hedging effect? So let's reduce the capital usage and adjust the fixed rate in such a way that it fully reflects a present day value of 0 for the swap contract. Frage ich nochmal kurz auf Deutsch nach. Ist es jedem klar, warum man letztlich in einem Swap-Kontrakt immer den Swap-Satz, den nennt man dann so, the Swap Rate, warum man den Swap-Satz so festlegt, dass der Vertrag am Anfang einen Wert von 0 besitzt. Die Alternative wäre, dass man sagt, ich will aber eine fixe Zahlung von 10%, nicht von 2% haben. Dann ist der Vertrag für eine der beiden Seiten viel vorteilhafter. Der Vertrag hat einen positiven Wert und die eine Seite, die stärker profitiert von diesem hohen Swap-Satz, muss erstmal 5.000 bezahlen. Aber warum? In der Regel sind bei Swap-Kontrakten beide Seiten eigentlich nur an der Absicherungswirkung interessiert. Also kann man den Swap-Satz auch gleich so festlegen, dass er so niedrig ist, dass er einen Wert von heutzutage plus minus 0 ausmacht. Gut. Market conventions. Yeah. Valid reference interest rate is thus always set one interest period in advance, and you need to fix the relevant market convention when it comes to interest compounding. What does it mean? You have some standardized market conventions here. Actual 360, 30, 360, 30, 365. Those are market conventions and fictions you assume when it comes to the question, how many days does 1 month have and how many days does 1 year have? You can simplify it all by simply assuming 30, 360. Each month assumably has 30 days and thus the year has 360 days. And then if you have a leap year, Schaltjahr, or a month with more or less days than 30, you have to have some rules in place what to do now. The question is, do you have to pay the interest rates on the 31st, on the 1st, or if you are in February, do you pay on the 28th? Do you pay on the 3rd of March? So this needs to be fixed, and both sides need to know when you have to pay up. Otherwise, if you don't pay, and if you're in default by 1 day, and that should not be the case. So I told you, usually you fix the swap rate. That's the complete fixed rate interest rate payment. You fix the swap rate in such a way that the swap contract has a present day value of 0. Okay. This is an OTC market, meaning that you have no data. If E.ON enters a swap contract with a trading house on Brent oil, no one will notice this. This is an OTC traded contract between two parties, and no one needs to be informed about this contract because it's not traded on the exchange. And there is no exchange that could publish any data. So what happens is, in some cases with these markets, in OTC markets in general, market participants have seen the need to publicly make these data available. So the large players, institutional investors, investment banks, and so on, they've come to the common agreement that they should all, if they participate in this market, they should all publish effective swap rates, for example, so that everyone can orientate based on these effective swap rates. But they don't need to publish that. That's an OTC market. You have some data, but in the basic scenario, only voluntary data by those market participants. Now, after the financial crisis, OTC markets have been heavily criticized for this intransparency, because these are important parts of the financial sector, and regulators don't really know what happens in these markets. So in some markets, in some parts of the OTC market, regulators have stepped in after the financial crisis and have stepped up transparency requirements and regulation on these products. You get a very good example and a very good impression of what can happen in such an OTC market when you take the scandal, the Libor scandal, Deutsche Bank has had for a couple of years now. The Libor is also a very good example for this. The Libor is the London Interbank Offered Rate. So this is an interest rate. It's not one interest rate, actually. It's an index, it's an average of those interest rates that investment banks and banks in general have agreed upon when lending money from one bank to the other bank in the interbank sector. And because banks wanted some transparency in this market, they said, okay, let's all agree, we're just a bunch of market participants, let's agree on a certain mechanism that at the end of each day will merge our effective rates we've had this day, on this day, in the interbank market, and then someone independent will calculate an average, and this average will be called the London Interbank Offered Rate. And it will be published, and on the next day we know what was the average of the interest rate in the interbank sector. Now, what did Deutsche Bank do? Assumably, allegedly, they knew, some of them, some traders knew that, well, many things are connected to the Libor, like interest rate swaps. Right? So variable interest rate you can use in a swap contract. And if you are a major player in this market, in the interbank market, and you know that the London Interbank Offered Rate is calculated as an average of the offered rates that are transmitted to this independent organization, person who's calculating the average, why not tell them a wrong interest rate? Simply adjust the interest rate you are transmitting for the calculation of the average, and because you're Deutsche Bank, you're such a major player in this market, you know how Libor will be affected. Because if you have a market share of, say, 20% in the market, and if you increase your alleged offered rate by 1%, you know that more or less the average will increase by 0.2%, so 20 basis points. And they did this. They published wrong offered rates for the calculation of the London Interbank Offered Rate. They knew in advance how Libor would react, and then they traded on that and made a profit. And this obviously is highly illegal and market manipulation. And this happens, of course, because this is an OTC market. You don't have an exchange where interbank loans are traded on, but these are traded directly between two market participants, and they have only agreed voluntarily to publish this data. And then it's prone to manipulation. But this is a very extreme example. This is a plain vanilla interest rate swap. You can see we still have Libor here. Rather, you should use the Euribor. It's a fixed variable interest rate swap. Reference interest rate is a 6-month Euribor. nominal value of the swap is not subject to changes during the term of the swap. So if you enter a swap contract for 1 million euros, you cannot increase or decrease this after you have signed the swap contract. So it's fixed. The agreed fixed interest payments correspond to the market level in the form of a market interest rate for the maturity of the swap. As a result, no settlement payments, no price at the beginning and at the end of the swap contract. That's a very plain vanilla interest rate swap. Yeah. Valuation is clear. In the end, you're interested in a fair swap rate. That's what you're looking for. So the valuation is the value of a floating rate note, minus the value of a bond, of a coupon bond. And if you simply set this equation equal to 0, the only variable that is left is the fixed rate coupon. And then you have to adjust the coupon in the value of the bond to make sure that with this swap rate you get a price of 0. Okay. So why should you use an interest rate swap? First of all, interest rate swaps can be used to hedge interest rate. Banks have an exposure to interest rate risk all the time. They give out loans, they have variable payments, they have fixed payments on their asset side, on their liability side. So interest rate swaps are an important part of a bank's interest rate risk management. They can also be used to take advantage of interest rate changes. So if you know that interest rates will change, increase or decrease, you can try to speculate on that. And they, again, just like any derivative, they allow for a completion of financial markets. In essence, and in theory, any new type of financial contract that is not completely obsolete is an advantage and is an improvement on the market situation, because it makes the market complete, and as you know, it is an advantage and it means that the market becomes more efficient. So this is a good thing, in theory at least. And interest rate swaps can also be used to exploit arbitrage opportunities, well, just like any financial instrument. If you see anything in the market is mispriced, you can try to exploit this mispricing and to have an arbitrage profit. Okay. So the following observations are based on an asset swap. So in the first example, we assume that we have a portfolio consisting of the following securities. We have fixed rate securities with a nominal value of N and a maturity of capital T. We are now expecting rising market interest rates. So if the interest rates increase, we'll hedge this with a pair swap. And the nominal value and the maturity should correspond to those of the fixed interest security. To simplify this, we assume that the nominal fixed interest rate and the swap rate for T years are the same. Then your hedging position corresponds to a variable rate bond, while the value of the hedged position is equal just to the nominal value. You've just hedged your whole position, and you've made sure that your nominal value doesn't change. By the way, hedging, of course, also means that if market parameters change to your advantage, you will also not profit from these advantages, from these favorable changes. But that's the price you're willing to pay to fix your investment. And this sounds, in this case, it sounds, I'm investing N and I'll be getting N back. That's not a very good return, N for N. But think of this example I've given you for the energy, for the gas company. You buy at 100 and you sell for 120, plus minus a variable amount with some fluctuation, with some volatility. But if you know that you are buying for 100 and you're selling for 120 and you can fix it, it's a good thing that you can fix the 120 at 120, because then you will have a guaranteed fixed profit of 20. So in many cases, you will use these instruments if you realize that you've made a profit and you want to fix this profit and you want to make sure that you don't turn those profits into losses. Now, for active risk management and interest management, we assume that an investor has invested an amount of capital at a fixed interest. So there's no direct interest rate risk for the investor during changing market interest rates. However, in the medium to long run, there's an opportunity for a profit from rising interest rates. Now, assume an investor that has acquired an interest-bearing security with a 5% nominal interest rate and a 5-year term, 2 years ago. Now, if the investor expects rising market rates, he can take advantage of the interest opportunity by concluding a fixed floating rate swap with a term of 3 years. Same case as with the gas company. You've bought at 120. Let's assume you could now sell at 100 or 100. Then, of course, you would wait. But as soon as you've realized, okay, the price is now at 120 after 2 years, now let's fix it for the remainder of the term. The same is here. If you have an investment and you see that interest rates will increase, you wait for some time for those interest rates to rise and to increase. And if they have risen to a satisfactory level, just use the swap contract to fix your profit, to realize those profits. So you have investor 5%, pays 5% in the swap, and it gets the Euribor in return. Now assume that interest rates will increase as expected to 7%. So it can do now what? Can use a swap contract, and the swap rate for a 1-year swap now assumably is 6%. So the investor concludes a second swap, paying the variable interest and receiving a fixed interest rate in return. And we fixed this 1% margin. That's the difference. You can see this in the next slide. You have the investor. He gets 5% fixed. He swaps the 5% first with Bank A for a LIBOR. He or she now gets a variable payment. And after some time, market rates have increased, and he can now enter a second contract, a second swap contract, and he or she will get 6%. So just by concluding and by entering these two swap contracts, you can turn a 5% fixed return into a 6% return. Under the assumption that market interest rates have increased from 5 to 7%. Of course, if market interest rates will increase from 5 to 7%, the swap rate will also increase from, let's say, 5 to 6%. One has to be clear, these two swaps are entered at 2 different times. So this plot has to be seen in the following way. This here is at time t1, and this here, or the second swap, is at time 2, after, I think, 2 years. So that's important to see here. Okay. Now, if the investor expects falling market interest rates, active interest management can be done with the help of reverse floaters. Now let the investor have an interest-bearing security with a nominal amount of N and a nominal interest rate of R1. He then enters a swap contract with the same nominal amount N, in which he pays a variable interest in exchange for R2. And the resulting transaction is shown on the next slide. So the investor receives a total of R1 plus R2 minus this variable payment. However, still exists a risk for the investor that this variable payment is larger than R1 plus R2, and then you can also eliminate that remaining risk by entering an interest cap. So this is shown here. You have R1 here. I receive R1 and I receive R2, and I'm paying RV, which is variable. So obviously, if I pay out more with my variable interest rate, then I get fixed R1 plus R2, then I might have a risk, and then I can do an interest rate cap to cap this. So what's an interest cap? In the case of an interest cap, the buyer of the cap receives an interest rate R from the seller in return for payment of a percentage premium of the nominal value. So if a previously fixed reference interest rate is below the cap, the buyer receives an interest rate of, say, 0%, and if the reference interest rate is above the cap ist meistens irgendwie Kappungsgrenze, Schwelle, the buyer of the cap receives the difference R minus R cap. So we have a cap, let's say 10%, let's say 1%. If the current variable interest rate is below, I get 0. If it's at 1.5%, I get 0. And if it's at 2%, I get 0. And at 2.5%, I get 2.5 minus the cap, so 1.5%. So the payment, the variable interest rate, is capped, ist gekappt, gleiches Wort im Deutschen, by this interest rate R cap, by the cap. And then you have this cap here, you pay a premium, and you get R, which is RV minus R cap, in case the variable interest rate is higher than the R cap. And then you can construct a reverse floater with an interest rate cap. You get R1. No? I don't have. Where do I have? Okay. You have R1 here. You pay R1. You buy the cap. And here you have the receiver swap. And then you can combine all these to make sure that you make a profit and hedge your remaining interest rate risk. You can also use interest rate swaps for synthetic creation of a fixed interest bond, realized by simultaneously purchasing a fixed interest security, concluding a fixed floating interest rate swap as a receiver. And you can do all of these things. In German, this is the case of a Hypothekendarlehen mit variabler Verzinsung. You can just leave that out. It only means to show you that as an interest rate swap and the related products like an interest rate cap, a reverse floater, and so on, as these are very, very simple instruments, you can use these together with floating rate notes, coupon bonds, to construct a set of instruments with increasing complexity. And here, for example, you have this debenture bond. And last but not least, we also have a T plus S forward swap. That's a transaction with a swap as an underlying, so it's again more complicated derivative. In a T plus S forward swap, the contracting parties agree on a swap transaction that takes place over S periods from time T on, and a cash settlement can already take place at time T. So what is it? It's a forward contract on a swap contract. Just like the swaption is an option with a swap contract as the underlying, a T plus S forward swap, or just a forward swap, is a forward contract on a swap. Difference being you have to enter the swap contract and you don't have the option to enter the swap contract. And this is a T plus S forward swap. And yeah, it's the same as a forward swap, just you agree on it now and it will only start at T for S periods. Okay. We've already seen swaptions. You can differentiate between receiver and player swaptions. And this is very simple. The long receiver swaption, you buy the swaption, and if the option is exercised, you have a swap contract. Just like a stock option is an option where you can buy or sell the stock. In this case, you have the right to enter a swap contract. And that's a long receiver swaption. Now the underlying in this case is what? Remember that with options, mainly you will be interested in cash settlement. In this case, it might actually be that you are interested in entering the underlying in the swap contract. But if you want to do cash settlement with a swaption, what is the underlying price? It can only be the current swap rate. The swap rate fully determines 100% the swap price, right? And we said that we need to, in many cases, we'll fix the swap rate such that the price of the underlying is 0. Okay, but it also means that if the swap rate changes, an option that uses a swap contract as an underlying, the option's price will also fully depend on the swap rate. So you'll be looking at the swap rate. Increases and decreases in the swap rate will change prices of the swaption. Okay. This is for a long receiver swaption. This one is for a short receiver swaption. Okay. Long payer swaption, same thing, just the other way around. Long payer swaption, short payer swaption. Okay. Any questions concerning the interest rate payments and interest rate swap contracts? I've only given you examples for the swap contracts on interest rates. However, swap contracts are even more important when it comes to currencies, commodities, and commodities obviously including gas, oil, electricity. So this is very important, and in practice I would think that swap contracts are used more frequently than options and maybe futures. So any questions concerning swap contracts? Okay. So let's now turn to the Black-Scholes model. Does any one of you have ever heard of the Black-Scholes model or Black-Scholes-Merton model? You have? Okay. At Professor Schumacher's lecture? Okay. First of all, we need to agree on the simple question why we need this at all. And this is something that hopefully doesn't puzzle you, because my professors weren't really able to explain this to me, why we need this. Why do we need a pricing model? In the end, we know nothing about assets. We only know how assets and financial instruments are designed when it comes to their current and future payments. But if I told you that I would enter a financial contract with you and I would pay you €1 today, €2 tomorrow, €5 in 1 week, maybe €200 if, I don't know, if it rains next month. I can give you the design of the contract. I can tell you the features of the contract, but we do not know what this should be worth today. The price is unknown. Where should the price come from? Price can come from market and supply, from a market mechanism, so that market participants will trade and we can observe a price. That might be possible if I gave you a new contract, just like the one I came up with. There is no market for that. It's a unique financial contract, so there will be no market price. So what should we do? Well, we are in economics, in financial economics at least. We should come up with the theoretically founded model that, under certain assumptions, tells you what such a financial instrument should be worth. What should the price look like? And then we can see whether our theoretical prices are any good if they match with empirical prices, if we have market prices. If it's a weird made-up contract, just like the one I did, then probably we don't have market prices, we only have theoretical prices. But it's in the end, it's all about market pricing, asset pricing. We want to learn more, how should these prices of these assets look like in theory under mild assumptions. And the most basic assumption is that of the market being free of arbitrage opportunities. arbitrage is quite simply mispricing. You have one good, two prices. Very simple. If you can buy a perfume here for 50 euros, and if you can sell it on the internet at 70, you buy for 50, you sell for 70. If transaction costs are okay, or if you have no transaction costs, that is an arbitrage opportunity. Arbitragemöglichkeit, Möglichkeit für einen Arbitragegewinn. What is an arbitrage profit? Arbitrage means using and exploiting a mispriced good and mispricing to earn a risk-free profit. I only need to buy for 50 and sell it for 70. Now I'm what is called an arbitrageur. Im Französischen kann man es schön aussprechen, arbitrageur. Same word in English, unfortunately, and if I pronounce it in English, it will be arbitrageur. And what do these people? They are speculators. They see the mispricing, they step in, they buy for 50, drive up demand, they sell at 70, they drive up supply, and what now happens is, if you buy for 50, the shop will notice this and increase prices, and if I now sell at 70, I sell one additional piece of this good, and there is no oversupply or higher supply, and the price will go down. And because arbitrageurs will step in and exploit this mispricing, well, markets, a functioning market, and the market mechanism will equalize supply and demand. Market will be in equilibrium again, and the two prices will vanish and will only have one price, say at 60. So that's the best case scenario. We have arbitrageurs exploiting arbitrage opportunities, driving market prices towards the fair price, the theoretically fair price. Okay. Now, with derivatives, in theory, yes, this could also be done, but we cannot simply take linear assets like a swap, like a stock, like a bond, like a floating rate note, and construct the payout profile of an option by duplicating, by replicating it. Say this in German. Die einfachste Strategie, jetzt eine Option, für die wir auch einen Preis bestimmen wollen, die einfachste Strategie wäre wieder zu sehen, ach wunderbar, die Option, das ist ja einfach nur 2,5 mal ein Floater, minus 3 mal einen Bond und noch ein kleiner Swap dazu. Ich habe die 3 Preise, dann muss ich das ausrechnen und bin fertig. Klappt leider nicht, weil das sind alles lineare Assets, da haben wir gesehen, deren Auszahlungsprofile passen nicht so, dass man sie kombinieren könnte zu einer Option. Okay, so what do? We need a sophisticated model for option pricing. And this one's a beauty. This one's such a beauty that Black-Scholes and Merton, actually all three of them would have gotten it, but Fisher, I think Fisher-Black was already dead at the time. Not all three of them, only 2 of them received the Nobel Prize in Economics. And actually, unluckily for you, Robert Merton visited the University of Leipzig, I think 3 or 4 years ago. We had the meeting of the German Finance Association here, and the keynote speaker was Robert Merton from the Massachusetts Institute of Technology, Sloan School of Management. And you will usually hear it called Black-Scholes. I like to refer to Black-Scholes Merton. I will tell you why Merton did the same thing at the same time from a different angle. So it should be considered the Black-Scholes Merton model. And Merton actually received the Nobel Prize for it, so it's a little bit unfair to call it the Black-Scholes model if Merton got the 1/2 of the Nobel Prize for that. I will give you, we will talk through this in detail, because this is very fundamental and this is important. And it's important to me for you to understand the the mathematical mechanics behind it. Why? I don't know how Professor Schumacher does it in his lecture, but I know from my personal experience, I was given this model and I was given the formula for the option price at the very end in, say, 20 or 30 slides. I wasn't given the explanation why someone came up with this model, and I wasn't able to understand the full beauty of this model. But every year I do this with students. I will give you the full explanation, the full derivation of the model, and then hopefully you will see why this is such a beautiful model and why this is such a fundamental model. The ingredients, the key ingredients are: we need a mathematical model for the stock price. Black-Scholes-Merton pulled that one from mathematical physics. They just realized that there is something in mathematical physics, mathematischer Physik, that is used in physics to describe the flow of particles in, say, water, and actually the same model can be applied to stock prices and stock returns. First ingredient. The second ingredient is a fundamental result from mathematical, from stochastic calculus, stochastische Analysis. Something, is anyone studying mathematics? No. If you were to study mathematics, you would know that stochastical calculus comes at a very late stage of mathematics studies. So you don't want to do that. And the result is that if you assume this model from mathematical physics for the stock price, then the option price follows a very, very similar process, just with slightly different parameters. But you know, the mathematical law behind the stock price is virtually the same under this assumption as for the option price. Only the parameters will change. And then you do the following. You create a portfolio. You take the option and you take the stock. That's a portfolio. Then you think, how can I fully hedge this portfolio? And there's a very simple result and a very simple idea how you can make this portfolio risk-free. Now, this is where our idea of arbitrage freeness comes into play. What return should a risk-free portfolio give you? If you have something, if you have a portfolio that is risk-free, ein risikoloses Portfolio, welche Rendite sollte die liefern auf einem arbitragefreien Markt? The risk-free rate, die risikolose Verzinsung. But if you know that this risk-free portfolio should give the risk-free rate, well, you have an equation. Left-hand side is known, right-hand side is known, and you can solve this equation. Sie wissen dann, wunderbar, linke Seite, risikoloses Portfolio, Option und Underlying, also Aktie, rechte Seite risikoloser Zinssatz, wunderbar, haben eine Gleichung, müssen Sie auflösen nach dem Optionspreis. This is where it gets tricky. We'll see that this is quite a difficult equation, and you need sophisticated methods from mathematics to solve this equation. But we don't need to do this, we'll simply accept the result. And the result will be a general pricing formula for any derivative, not just an option, not a call, not just a put, for any option on this underlying. So it's the most basic, most general pricing formula for a derivative on any type of underlying. The question then only is, do you get an easy solution to this equation? Do you get a formula? Or do you need to put your computer on it and let your computer work a couple of weeks or days or hours on finding an approximate solution to it? That's the only difference between maybe this option and that option. So this is why the Black-Scholes model is such a beautiful model. It gives you the most general result you can hope for the pricing of any derivative on any type of underlying. Everything else is just a matter of computation. Also das Black-Scholes Modell ist anwendbar auf jedes Derivat für jedes Underlying. Man findet in deutschen Lehrbüchern leider immer nur den Fall, ja, das ist für eine Option und das ist die Formel. Der einzige Unterschied, den man dahinter sieht, ist, für manche Optionen, die einfach sind, haben sie eine Formel, haben sie eine einfache Lösung. Für andere Optionen haben sie keine Lösung, da müssen sie mit dem Computer Näherungslösungen berechnen. But we'll see this. So, first things first. We need the model for the underlying price, for the stock price. And we'll use what is called a random walk. What is a random walk? A random walk in d dimensions is the sum or a set of vectors where you start at one point, and I'm doing this now in 2 dimensions. I'm taking a random direction with a random step length, so like this. And I'm now here. Random direction, random step length. Random direction, random step length. And if I combine all these steps, I get a random walk. For obvious reasons, this is also called a drunkard's walk. Der Gang des Betrunkenen. That's a random walk. The most random process, obviously, there is. That's a random walk. What is now of interest is the so-called end-to-end vector. In 2 dimensions, I start here, and I go like this, again, and I'll stop here, and the end-to-end vector will be this starting point to my end point. If I do this here, I can plot this here. This is my random walk. And now, what is the end-to-end vector? The end-to-end vector is this. Start to end point. So what's the end-to-end vector? With random direction and random step length, the expected length of this vector is 0. So the drunkard will start at some point, and in expectation, im Erwartungswert, he or she will end up at the same place. He will not go far. The expectation of r squared is approximately the average of r squared, and that is proportional to the number of steps you've taken. Don't need to bother about that. We'll need this later on for the variance. Because, as you know, you can calculate the variance by expectation of r squared minus the expectation of r squared. So the variance of the end-to-end vector, well, we're using this here, is if the expectation of r is 0, then the variance is proportional to n. So the more steps you take, the more variance your end-to-end vector will have. And this proportionality of the expected value and the variance standard deviation of r squared to n, or the square root of n, is in fact one reason why you might see in textbooks on risk management a conversion formula like this. You have a 1-day value at risk and you want to convert it to a 10-day value at risk, and you see something like, okay, just take the 1-day var times the square root of t. Why did you do this? Well, implicitly you are assuming a random walk and you are taking the square root of the variance, the standard deviation of the end-to-end vector, and this is how you transform this. So implicitly you have an assumption of a random walk. That's not too important. What is more important is the following. The end-to-end vector of a random walk is normally distributed with expected value 0 and variance b squared times n, where b squared is this sum of the squared step lengths. Ri is the length of the step r step I. So this would be 1 Ri, this is the second Ri, and so on. I'm wandering around here. Why is this interesting? Because now you can see a random walk suddenly leads to the normal distribution. And we can see next. If you assume later a random walk for your prices or your returns, this implies the assumption of a normal distribution. And this is usually the time when German textbooks will phase out, and they would only tell you, you assume a normal distribution for your stock prices. Wrong. You're assuming a random walk, or later on a Brownian motion. The assumption is that of the stock price following a random walk, not a normal distribution. But if you assume a random walk, then by assumption, you have a normal distribution for the associated end-to-end vector. So that is the difference. Now we now want to model the stock price evolution via a random walk. So first, oh, by the way, the random walk for the stock price is obviously not in 2 dimensions, but in 1 dimension. Up, down. More up, less down. In 2 dimensions, you can also find random walks in 3 or 4 or 5 dimensions and so on and so forth. But for stock price, it's up or down, right? So we'll consider a random walk in 1 dimension. Time dt elapses per step of the random walk. And during the whole random walk from small t to capital T, the time that elapses is capital T minus t n steps of time dt. dt is meant to show you that it's the difference in time, dt. And then we could think of the random walk being a model for the changes in the stock prices, DSI. SI is the stock price at time I, and you take the stock price before that, so SI minus 1, and DSI is the change, the difference in the stock price. Problem is, the random walk has something that is called the self-similarity. That means if you start here and you take the first step, this first step could also be considered a second smaller random walk. So each step of the random walk is a random walk itself. It's the end-to-end vector of a different, smaller random walk. And that means a security with a price of 1,000 euro would have the same price fluctuations, the same volatility as a security with a price of 10 euros. So relative price fluctuations should be considered, not actual, not absolute price changes. Also Sie sollten sich nicht 5 Euro Veränderung angucken, sondern eher 3%, 4%. Weil ansonsten hätte eine Preisänderung von, Sie starten bei 1000 und er geht auf 1080 hoch. Dieser Prozess hätte die gleiche Fluktuation, die gleiche Varianz, wie eventuell eine Aktie, die nur 1 Euro kostet und die 10% hochgeht. Und das darf halt nicht sein, aufgrund dieser Selbstähnlichkeit des Random Walks. Then let's turn to relative changes, SI over SI minus 1. So instead of plus 5 euros, we are now looking at 102% change. Problem is, the random walk, because of self-similarity, you should be able, in vector, you know this from high school, that if you start here with a vector and you go this way and this way, adding all those little steps should give you the same vector as the end-to-end vector. Everyone clear on that? Simple algebra from linear algebra from high school, geometric algebra, geometry actually. This doesn't work here. Because if you try to add S1 over S0 plus S2 over S1 plus S3 over S2, you don't get ST over S0. Wenn Sie S1 geteilt durch S0 plus S2 geteilt durch S1 alles aufsummieren, kommen Sie nicht auf ST über ST geteilt durch S0. So this doesn't work. These don't work. But we don't need to despair. Log returns, they work. The difference in the logarithmic prices, aka the log returns, they work. The logarithm of SI minus the logarithm of SI minus 1, usually known and referred to as the log return, stetige Log-Rendite, they can be modeled as a log return, as a random walk. This is no coincidence, actually. The random walk with the normal distribution is a continuous distribution. It's eine stetige Verteilung. The changes using the logarithm gives you it's a continuous function, and these are also called continuous returns. Stetige Renditen, nicht die diskreten Renditen. And it doesn't surprise us that continuous returns can only be modeled using a continuous process. Or if we want to use a continuous process, we need continuous returns. So log returns. If you have ever wondered, why is everyone using in these models? Banks use discrete returns. Why, in theory, in finance, why is everyone using log returns? This is one reason, because we can make a nice assumption on the underlying price. We can use a random walk, which is a quite nice, sophisticated model, but it requires us to look at log returns. This works if we add those log returns. We get the log return from the very start to the very end. Perfect. And next, we need probably the most basic type of stochastic process. I'll first define what a stochastic process is. A stochastic, you know, a random variable. A random variable is a stochastic model you use for modeling the stochastic behavior of one phenomenon, one process. What is a stochastic process? A stochastic process is a set of random variables that are indexed with an index t. And that's it. If the index set is infinite, you have a continuous stochastic process. If the index set is finite, it's a discrete stochastic process. Ein stochastischer Prozess ist nichts anderes als eine Menge von indizierten Zufallsvariablen. xt mit t gleich 1, 2, 3, 4, 5. Dann haben Sie einen diskreten stochastischen Prozess. Wenn Sie sagen xt, t größer 0, unendliche Indexmenge, dann haben Sie einen stetigen stochastischen Prozess. Very simple idea. And why? At every time, on every day, at every point in time, the random behavior of the stock price, the stochastic law governing the time evolution might change. And this is why we don't need one random variable, but we need a set of infinite random variables so that the stochastic behavior can change over time. Alles andere würde auch keinen Sinn ergeben, wenn Sie sagen, ich modelliere jetzt hier das stochastische Verhalten der Aktie mit einer Zufallsvariable, weil dann kennen Sie das ja. Dann würde sich das Zufallsverhalten nie wieder verändern. Wenn Sie jetzt einen Würfel nehmen, ja gut, dann wissen Sie halt, es kommt immer 1, 2, 3, 4, 5, 6 raus. Aber bei der Aktie kann sich das halt auch mal im Zeitablauf verändern. Dass die ganze Verteilung sich ändert. Und deswegen haben Sie hier eine Menge an Zufallsvariablen und es ist vorab nicht gesagt, wie die sich verhält. And a Wiener process is a time-continuous, zeitstetiger, stochastic process that has, and actually you write this in the following way. You write this like this. X t in parentheses t larger than 0. That will be the stochastic process. And a Wiener process now is a time-continuous stochastic process that has normally distributed independent increments. What is an increment? An increment is the difference between xt minus xt minus 1. That's an increment. Or xt1 minus xt2. Maybe that's a better definition. So the change from one point in time to the next. That's the increment. Germans say word Inkrement, ja, oder Zuwachs. So it's just a set of random variables, and the changes in this process from one point in time to the next, these changes are independent in time. So it doesn't matter if I'm looking at the change now, or in 1 month, or in 1 second, or in 5 seconds. The stochastic law stays the same, and these are normally distributed. And you can write this in the following way. You say that time changes with dt, that's the difference in time, and the change in the process is dw, the change of the Wiener process, by how much this process changes. And these changes, these increments, these are normally distributed with expectation 0 and variance dt. So you'll have a set of random variables x. They are standard normally distributed with n10, and dw is x times the square root of dt. Expected value is always 0. Variance is dt. So very simple process. And we'll now consider an infinitesimally small time change, dt. So it's no longer from now to the next day, but from now to the next infinitesimally small amount of time. So a very small change, infinitely small change in time. And what do? We take the log prices, the log returns, and under the assumption of a random walk, in continuous time, we get the change in the logarithmic prices. The log returns are given by sigma times a Wiener process. And that's more or less everything we need for the stock prices now. We want to model the changes in the stock prices, the evolution of the stock price of the underlying prices, and we'll assume a random walk. We'll have a random walk assumption. And if we assume a random walk, it means that the changes in the logarithmic prices, the log returns, will be given by a Wiener process times a variance parameter, a diffusion parameter sigma. And we'll write this, d ln st is given by sigma times dw. Sometimes you will also see dwt, but this is implied, right? Okay. Now, if you were to use this model, it would mean, remember, changes are normally distributed with expectation 0, and now a variance sigma times sigma squared times dt. So that would mean we'll assume a variance sigma squared, let's say 5. And if we were to take this process, it would start at 0 and it would only wiggle a little bit around 0 with according to this parameter sigma. Is this very good? Well, for a log return, it might be that it's not just a flat line around 0, but maybe it has a drift. It wiggles a little bit, but increases for some time, then it goes down. So it could, instead of looking like this, maybe it looks like this. This looks a little bit more like a stock price or like a log return. So we need to add a drift. Easiest way to include a drift is to take the logarithmic stock prices and not just to write it sigma dw, but to add a drift component. A second parameter, mu, simply times dt. Mu times dt. What happens now is mu is not the expected value, But it determines, obviously, it determines the expected value. And because of this, because it's not exactly the expected value, it's called the drift. And sigma is not equal to the variance or volatility, so this is why we call it the diffusion parameter. μ und Sigma sind nicht Erwartungswert und Varianz, aber sie bestimmen natürlich Erwartungswert und Varianz zu 99%. Und deswegen gibt man diesen beiden Parametern andere Begriffe, nämlich Drift und Diffusion. Diffusion drückt ja schon aus, wie etwas diffundiert, also wie etwas sich verbreitet, und Drift ist klar, das ist ein Trend. However, including this drift doesn't change the distribution, it is still a normal distribution. And you can also allow for non-constant drifts and non-constant volatilities, but this is only a question of how complex and how complicated you want the model to be. The more complicated, the more realistic it will be. You can also think about jump diffusion. Diffusion volatility stays at some level, and now suddenly you enter a crisis and diffusion is like this. Then you have what we call a jump diffusion. The diffusion stays at a certain level and then it jumps to a much higher volatility level. Very complicated model, more realistic. We don't need it. The model works fine just the way it is. On a side note, ST, the price itself, is log normally distributed. The log returns are normally distributed. Maybe if you want to have some fun, take a German textbook. Not mine, should be correct in my book. But if you take any textbook on risk management, especially from the 90s and 2000s, you will see, let's assume a log normal distribution for the prices, and consequently, let's assume a normal distribution for the log returns. That's wrong. You are assuming a random walk. And the normal distribution is a consequence of that assumption that you've made before. Now, at the end, let me comment on one thing. You will sometimes also read, you assume a Brownian motion, a Wiener process, a random walk, a Brownian motion are actually, well, if that were possible, three sides of the same coin. It's all the same. You've seen a random walk is a process. It is closely related to the stochastic process, to the model that is the Wiener process. And the Wiener process is the physical, it's the physics model used to describe Brownian motion in nature. Die Brownsche Bewegung ist das physikalische Phänomen. Der Wiener Prozess ist das Modell aus der mathematischen Physik, um die Brownsche Bewegung zu beschreiben. Und der Random Walk ist natürlich auch damit verbunden. Brownsche Bewegung, vielleicht hatte jemand von Ihnen Physik-LK, ich habe Physik nach der 11. Klasse nicht mehr gesehen, aber wenn mich mein unzureichendes Allgemeinwissen nicht täuscht, ist die Brownsche Bewegung das Verhalten zweier Flüssigkeiten, wenn die eine in die andere diffundiert. Wenn Sie also jetzt, nehmen wir mal, Sie nehmen einen Eimer Wasser und Sie nehmen eine blaue Flüssigkeit und kippen die rein, dann stellt sich ja die Frage, wie sich die Moleküle der einen Flüssigkeit oder des einen Gases in die andere diffundieren, oder auch so Fälle, wenn Sie zwei Gase haben und Sie lassen das eine Gas gleichmäßig durch eine Trennwand in das andere Medium einfließen, wie verteilen sich die Moleküle? Und die Moleküle wandern natürlich fast 100% zufällig dann rum und das Diffundieren, das ist die Brownsche Bewegung. Und dann die Verallgemeinerung dieses Prozesses, den wir gerade gesehen haben, der nennt sich dann in der Physik Diffusionsprozess, und dann sind wir eigentlich fertig. Eigentlich sind wir jetzt schon fertig. Das ist das Modell, mit dem können wir arbeiten. Hier d ln st gleich μ dt plus Sigma dw. Alles andere ist nur eine Erweiterung, macht das Ganze realistischer, vielleicht ein bisschen allgemeiner, aber Sie haben es verstanden. Ne? Sie haben eine Driftkomponente, die sorgt dafür, dass Ihre Rendite ein bisschen mal nach oben im Trend oder nach unten im Trend gehen kann. Sie haben letztlich eine Streuung, die eingeführt wird durch den Wiener-Prozess. Und damit können wir dann beim nächsten Mal weiterarbeiten. Das ist der allgemeine Diffusionsprozess, aber der ist auch nicht viel anders. Haben Sie Fragen? Do you have any questions? Maybe for next time, try to have a look at this, how this derivation of the model continues. We now have the model for the underlying price. What we need to do next is to find a way to describe the option price. The option price will simply be a function in the underlying price. Optionspreis ist eine allgemeine Funktion im underlying Preis. Und dann geht es von da aus weiter. Okay, thank you for your attention. See you next week.